Hello and welcome to Chapter 12 Notes. And so in this chapter, we're going to start off by talking, this first lecture video, we'll talk about decentralized organizations and centralized organizations and responsibility accounting. Then we'll start talking about how to calculate return on investment, and we'll talk about residual income, we'll talk about transfer pricing, and we'll also talk about the balanced scorecard. The lecture videos in this chapter will probably be split up into a few different lecture videos, okay? So let's start off by talking about decentralized organization. So decentralized organization is one that grants a lot of decision-making authority to managers of divisions. And of course what I say here is very true, that most firms are neither totally centralized or totally decentralized. These are two ends of a continuum. So when we think about decentralization, what we're talking again about is granting a lot of decision making to our lower level or mid-level managers, a manager of a division, for example. So when I used to work for electronic data systems, we had a division of military systems and a division of government services. Those two, if we were talking about a decentralized organization, we would be talking about giving a lot of leeway to those managers to make decisions that affect their own divisions. And so when we talk about some advantages of this approach versus a very centralized organization, let me just talk about centralized, would be that the manager of military systems doesn't have very much leeway to make decisions that they have to check with upper level management first before they embark on some decisions that affect their own division. So again, this is a matter of degree, two ends of a continuum. So when we talk about some advantages of decentralization, some of those would be a better information that leads to better decisions, with the thought that the managers that are closest to the problem know the problem the best, and those would be the division managers. Also, that would lead to being able to respond faster to different circumstances. It can lead to more motivation for managers in the sense that they feel more empowered to make decisions that affect their own division. And of course, I think a good idea is that provides excellent training for future level executives. I mean, they're put on-the-job training. To me, there's nothing like on-the-job training, okay? We talk about some disadvantages of decentralization. We can have some duplication of duties. And so, you know, the idea of decentralization and centralization can apply not just to, do we let managers have more decision-making capabilities, but we could apply it to, for example, an IT organization. So I'll give that example right now, kind of apply it in a different scenario in order to better talk about the disadvantages here. So when you talk about maybe an IT help desk or IT support, when I used to work at the College of Charleston, for example, that each area, so for example, the accounting department, the finance and economics department, had their own IT instructional resource. And so what this person would do, they would help you out with any kind of IT issues that you might have in the classroom. And so they would help us out. You know, probably we might have problems with the projector. We might have problems with our learning management systems. And they were designated to help the people in accounting, or help people in the marketing department, or other departments on campus also had that. The English department would have their own, for example. And so in some ways, you think about that, and you know, they know that division, they know the accounting faculty better, they know what some of the problems that they've had before, and so they're able to respond faster, and it can provide better decisions. But on the other hand, it does have some duplication of duties, because the person that would be helping the English department, well, faculty in the English department probably also have problems with their learning management systems, and maybe also have problems with projectors. And so that knowledge has to be duplicated across all those different instructional resources. The other disadvantage of decentralization could be a lack of goal congruence, that we might have managers that could pursue goals that could benefit their own division, but maybe not be that great for the overall company. And vice versa. You could have a project that could be good for the overall company. It has a positive net present value, for example, but this one organization's return on investment is already pretty high, and taking this project may actually reduce their own return on investment. So they say, well, I don't want to do that. Okay? So that's what we talked about over here. It could be in their own goals, their own division goals could be incompatible with the overall company goals. Okay? So continuing on, this is just a little diagram over here. When we talk about the total business environment, we could have the decentralized organization. Let's talk about responsibility accounting over here. So responsibility accounting is a way for us to trace revenues and costs, and then of course profits, to different division managers and to organizations. It's a cost and revenue tracing technique and mechanism. Okay, so when I used to work in industry, we used to have responsibility centers, and these responsibility centers had a manager that was tied to them, and then that manager worked for a division. So what we could do in order to build an income statement for a division, we could take all the revenues that were tied to the responsibility centers tied to that division, subtracting all the expenses for all the responsibility centers that were tied to that division. And we could do the same thing for a given manager. Okay? So it's a revenue and cost tracing system. That's what we mean by responsibility accounting. Okay? There's three different types of responsibility centers. So we have a cost center, we have a profit center, and then we also have an investment center. So let's talk about those three right over here. So when we talk about a cost centers would be responsible for controlling costs, but not for generating revenue. So if you wanted to look at the company cafeteria, for example, or the IT help desk, the internal IT help desk, they don't generate revenue for the company. They're just a cost center. And so what we want to do is to look at their actual costs against their budgeted costs. And if their actual cost is more than their budgeted cost, then we will hold them accountable for that. Other divisions that we could have would be considered profit centers. And so in that case, they do generate revenues. And of course, they also have expenses. So in that case, we're going to evaluate them in terms of the profitability. We're going to be looking at, does your actual profit, your actual net income, does it exceed your budget? And if it does, that's what I'm talking about over here, comparing the income, actual income to budget income, comparing your actual income this year to past income, so from fiscal year last year, okay? And then also comparing it with other profit centers. You made this much money, but the other division made more money, and so what was the issue with that, okay? The last type of responsibilities we have is the investment center. So in that case, what we'd be doing, the difference between an investment center and a profit center is that an investment center, the manager is going to have more leeway to affect investment decisions, so purchasing new equipment, for example. Okay, so in that case, if that's true, if the manager does have more leeway to make a big equipment purchase, to invest in assets, then what we want to do is hold them accountable for how much revenue, how much income do they generate from using their assets. So basically, how well are they using their assets to generate net income? Okay, so in that case, what we would be doing is evaluating them, the manager of the investment center, in terms of return on investment, not just profit, because we're giving them leeway to make some pretty significant investments in assets, and so we don't want to just hold them accountable for profit. We want to look at how well did you use your assets to generate profit, because we're giving you the leeway to invest in new assets, okay? We look at our quick check problems right over here. An investment center is going to be responsible for investing in long-term assets, controlling costs, and generating revenues, all the above. Cost centers would often be evaluated using not anything to do with profit, because they only generate expenses, so it would be variance analysis. Profit centers are often evaluating by looking at income targets or budget profits, okay? The rest of these would be more in terms of return on investment and better equipped, better situated towards investment centers. Okay? So let's go on and talk about return on investment, which is a type of tool for evaluating investment centers. Okay? And the way that we're going to calculate return on investment is simply by taking our investment center income divided by our invested capital. Okay? So we're going to talk about how do we measure our investment center income, how do we measure our invested capital. So if you just look at this ratio, return on investment is expressed as a percentage. There would be a couple different ways to increase return on investment. If I increase sales, income will go up. If I reduce operating expenses, income will go up because expenses are lower. If I reduce my operating assets, which is that, my denominator goes down, and then my return on investment goes up. Okay? And of course, I can do a combination of all three to increase my return on investment. Okay? So when we talk about the numerator over here, the way to measure investment center income, we can measure that in a couple different ways. And one common way that a lot of companies use is by calculating NOPAT, which is net operating profit after taxes. So it gets a little bit tricky here, and what we actually have to do in order to calculate net operating profit after taxes, we have to add back our non-operating items such as interest expense and then adjust our income tax expense accordingly. So if you look over here, for example, here's my income statement. I have my sales, and then I have my less my cost of goods sold gives me my gross profit, gross margin, less my period costs over here, my selling and admin costs gives me income from operations. Then I subtract out my interest expense. That of course gives me my income before taxes, and then I take my tax rate. In this case, it's 35%, and I can just do that by taking my taxes divided by my income before taxes, and if I do that, 2.1 million divided by the 6 million, I'll get 35%. That gives me my net income. Now, what you could do if you were given this much information, what you could do is you could simply take your income from operations, right, and then deduct your taxes. So you could take your income from operations less 35%, which would be your taxes, and then that would give you your net operating profit after taxes. Okay? But sometimes we may not have the income statement given to us in this much detail. So what if we have an income statement where they're just giving us net income and they're giving us interest expense, and what we actually have to do is back into figuring out income from operations. So what we could also do is we could take the other way that we could do that if we're not given quite all this information, and we'll see a problem later in the notes where we're not. We could take our net income, and then we have to add back our interest expense, because interest expense is a non-operating item. And what we're looking at is net operating profit. Operating profit. So interest expense is non-operating. So we add back our interest expense, okay? So we take our net income, we add back our interest expense. But here's the thing. So we look at our income before taxes, that's 6 million. That's after we've subtracted out our interest expense. So I'm going to take 35% of a lower number, right? So what I actually have to do is I have to take out my tax savings related to my interest expense, which in this case my tax rate is 35%. So I'm going to take out 35% of my 1 million, which is basically the tax savings that I get by deducting the interest expense. But if I'm not going to let you consider the interest expense, right, because I want to get that operating profit after taxes, I have to take away those tax savings. Otherwise, it's not fair. So I'm going to come over here. I'll take my net income, 3.9 million, plus my interest expense, less the tax savings, which is the tax rate, times the interest expense, gives me my net operating profit after taxes, okay? All right, so I'm going to end the lecture video here, and then we'll continue on by talking about return on investment. Thank you.